Welcome to the Deep Dive. Today, we're unpacking the Q3 fiscal year 2026 earnings call for Park Aerospace Corp., ticker PKE.
Right.
This one dropped just after the market close on January 13th. And it was not your standard quarterly update.
Not at all. This felt more like a foundational statement. Management really used some strong results as a launch pad to commit to this multi-year, very aggressive scale-up plan.
That's the perfect way to put it. So our mission here is to really distill that core message because it completely overshadowed the actual quarterly numbers and, drove some serious momentum in the stock.
Yeah, this call was all about capital allocation. It was a bullish story designed to convince everyone that the ROI on this new expansion is just going to blow away any, near-term pain from the financing.
Okay, let's get into it. But first, let's touch on the numbers themselves just to prove the underlying business is solid. PKE delivered a remarkably clean quarter.
Really clean.
Sales were strong, came in at about $17.3 million. That's a 20.3% jump year over year.
And that top-line growth was great. But the real story, I think, in the financials was the margin performance.
Oh, absolutely.
Gross margin expanded to 34.1%. You just don't see that kind of jump. That's a 750 basis point increase. Just huge.
And that boost just flowed right through to the bottom line. Adjusted EBITDA hit, $4.2 million? For a 24.4% margin.
Mm-hmm. And what's really reassuring is they didn't just meet expectations. They beat their own internal guidance. Their high end for sales was $17 million, and for EBITDA, it was $4.1.
So they're in control. It signals strong operational momentum and, I'm guessing, a very favorable product mix.
That product mix is exactly where we need to start. Because while 34% gross margin looks fantastic on paper, we have to ask, is it sustainable?
Yeah, that was my next question. Is this the new baseline or is there kind of a catch here?
There is a catch, and it's a critical detail. It's a really interesting timing quirk related to one specific product line, the C2B fabric.
Okay, explain that. Why the huge jump to 34% this quarter specifically?
It's all about what they sold and, more importantly, what they didn't sell. So PKE has two parts to this product. They resell the base C2B fabric. That's a low margin, almost pass-through item.
Okay.
And then they manufacture high margin ablative materials using that same fabric. In Q3, they had literally zero sales of that low margin fabric.
I see. So the thing that usually drags down the average was just completely absent.
Exactly. Instead, they sold about $1 million of the really high margin manufactured ablative materials. So when you get all the good stuff and none of the bad, you get this beautiful but, temporary headline margin.
That context is so important for their Q4 guidance then, because they're forecasting sales to be way higher, 23.5 to 24.5 million.
Way higher. But the adjusted EBITDA guidance, 4.75 to 5.25 million, it doesn't scale at all with that revenue jump.
And that's because
management was very clear about it. The Q4 forecast includes about $7.2 million in those low-margin C2B fabric sales.
Right.
So once you factor that big chunk of pass-through revenue back in, it pulls the profitability right back down to normal levels, even with the big top-line number.
Okay, so the margin story is complex. Let's pivot to what really got the market excited, this new juggernaut thesis. It's all defense, all scale up.
This is really where the macro story meets PKE's very specific, specialized position. The focus now is all on these long-duration defense programs, especially missile systems. And demand is, it's unprecedented. Everybody's trying to replenish their stockpiles.
And the centerpiece here is the Patriot missile system.
Mm-hmm.
PKE is sole source qualified for specialty materials on the PAS-3 MSE. That's the Missile Segment Enhancement Interceptor. A very, very valuable position to be in.
And the acceleration required is it's stunning. Lockheed recently announced a 7-year deal with the Department of War to dramatically increase PAS-3 production. Now, listen to this jump. They're going from 600 interceptors per year to 2,000 interceptors per year.
Wow. From 600 to 2,000. How does a specialty supplier, a sole source one at that, even begin to handle that kind of ramp?
That's the billion-dollar question, isn't it? And it's the core of this whole call. Management confirmed that PKE has been asked to increase its output by, and I'm quoting, significant orders of magnitude.
The pressure's on.
The pressure's definitely on. When the Pentagon tells the prime contractors to triple or quadruple production, a key supplier like PKE simply has to find a way. There's no other option.
And you could see that pressure in the Q3 results. Despite all the good news, they did note about $740,000 in missed shipments.
Exactly. And that wasn't a failure, it was a sign of the strain. They blamed it on international freight issues, some supply chain hiccups, and they said the industry is, quote, getting a little bit behind the power curve again.
The system is creaking a bit under the demand.
It is. It shows that execution is a huge challenge right now for everyone.
So that's the defense side of the juggernaut. But PKE's story isn't just defense. The commercial aero picture is also incredibly strong, right? Centered on GE Aerospace.
Oh, yeah. The A320neo family is potentially PKE's largest program over the long term. You got Airbus with a backlog of nearly 8,000 planes, and they're trying to ramp up to 75 deliveries a month by 2027.
A huge increase.
Yeah.
And PKE is right in the sweet spot because they supply the CFM LEAP-1A engine program.
And that engine is dominating. If you look at the firm orders for the A320neo, the LEAP-1A has a 64.5% market share. It's commanding.
And it helps that the competitor's engine,
Yeah.
well, it continues to have some reliability problems.
A huge help. I mean, that's been a key selling point for the LEAP engine. It just works. That dynamic is incredibly favorable for PKE.
And what does that translate to in dollars?
Well, management implies that these commercial programs alone could be worth about $62 million in annual revenue down the road. And that's a conservative number. It doesn't even include spares or scrap. The scale is just immense.
Which brings us back to the real message of the call, the thing that drove the stock capacity. The Q3 numbers were just proof that they can execute, justifying this massive investment they're about to make.
This is where the whole story pivots. PKE is planning a major new plant, about 120,000 square feet, probably in the Midwest, and it's designed specifically to double their current capacity.
Double it. That's going to cost some serious money. What's the budget and the timeline?
The estimate is around $50 million. The bulk of that, maybe $45 million, they expect to spend in fiscal 27 and 28. And the goal is to have the plant operational, actually selling product, by the second half of calendar 2028.
Okay, so how do you fund a $50 million project? This is where the at-the-market, the ATM, comes in.
Exactly. They filed an S-3 for a $50 million ATM equity program. And for anyone listening, that just means they can sell shares into the market over time to raise cash. It introduces dilution risk.
And that's the thing that normally spooks investors. But the market's reaction was the opposite. The stock surged on huge volume.
It tells you everything. Investors heard potential dilution, but they prioritized aggressive growth. They bought the ROI story on the expansion, and they see the ATM as just, a necessary tool to get there.
And management has a history of this kind of thing, right? Acting fast.
They do. They brought up the example of when they committed to build a redundant factory for the GE agreement without waiting for financing. They're basically saying this ATM gives them the flexibility to jump on these huge opportunities as they come up.
And when you put that $50 million investment against their long-term outlook, the math starts to look pretty good.
It really does. Management said that based only on the programs they know about today, Patriot, the A320, and so on, they see a path to about $200 million in sales in their target year, fiscal 31.
And they were careful to say that number doesn't include any new opportunities.
Right. They're basically saying we're spending $50 million to double capacity so we can quadruple revenue. That's a story investors will buy every time.
And they're not just building their own capacity, they're shoring up their suppliers too, right? With the C2B material.
Yeah, that was a key detail. They advanced almost 4.6 million euros to their partner, Ariane Group, basically as a prepayment to help Ariane Group expand C2B capacity in Europe.
And they're looking at a U.S. facility too.
They are. They're contributing 350,000 euros to a study for a potential C2B fabric plant right here in the U.S., driven by the Pentagon's needs. It shows they're thinking about the entire supply chain end to end.
Okay. So let's put this all together. It's time for the segment where we explore the plausible but aggressive trade ideas. And remember, this is not financial advice.
Not financial advice, but given the market's reaction, the trade idea here is pretty straightforward. You buy the capacity ramp, but you find a way to hedge the financing friction.
Meaning the ATM dilution.
Exactly. The market has basically said it accepts the $50 million in dilution in exchange for doubling capacity and that path to $200 million in sales. But the real growth, that Patriot ramp from 600 to 2,000, that doesn't really kick in until the new factory is running late 2028, early 2029.
So the idea is to position for that now, but without getting whipsawed by the day-to-day ATM selling pressure.
Precisely. Since the ATM creates this sort of unpredictable overhang, you never know when they're selling. So a plausible strategy could be using long-dated options to get what we call synthetic exposure.
You mean like LEA calls?
Yeah, LAP calls. We're talking contracts that expire way out in 2028 or even later. You're basically betting that the massive ROI from this new factory will become obvious in a few years, and you're buying time to let that story play out.
So you get the upside from the growth story, but you bypass some of the near-term noise from the stock sales. You're betting that the value from that Patriot ramp is worth way more than the $50 million equity raise.
That's the trade. It's aggressive, but it mirrors the aggressive thesis the company just laid out.
Okay, let's wrap this up. Let's recap the key theme here. The Q3 results were strong. They were solid, but they were really just the proof of concept. The real narrative here is all about scale.
Absolutely. KKE is making a $50 million bet to double their capacity, financed partly by that ATM, all to capture this simultaneous boom in defense with the Patriot missile and in commercial aero with the A320neo.
And we'll end on this final provocative thought for you to chew on. Management on the call openly embraced what they call the Pentagon's New World Order philosophy. This is a strategy that is actively pushing defense suppliers to pour money into capital investment, into boosting production, instead of just focusing on buybacks and dividends.
Right.
So when the government is effectively forcing a ramp from, say, 375 units to 2,000, what does that new strategic priority mean for the entire defense contracting industry going forward? Is this a fundamental shift?
That's a huge question. And we'll leave that thought with you. Thanks for tuning in to The Deep Dive.